I was always told that entrepreneurship was less about skill and more about mentality, meaning it's not as much about being great about a specific thing as it is about understanding how to monetize anything that you're good at. My journey into coaching started with a daily blog sharing how bad I was at trading, and I was able to turn that into a successful business which has worked with hundreds of thousands of traders across the world and was even recognized in Forbes magazine. So if I can do it, why can't you do the same? So start growing your business today by starting a podcast using Spotify for podcasters. I love them because they allow me to record, distribute, monetize, all from a single platform with just a click of a few buttons. I can also record video episodes and interact with you guys, my fans, by posting Q&A and poll questions. Best of all, it's free, which is massive since most businesses require significant startup costs to get going. So the way I see it, there's no risk or reward to at least giving it a try. So get started today at www.spotify.com/podcasters or download the Spotify for Podcasters app. And as the great Shia LaBeouf once said, just do it. In today's episode of the Trading Coach Podcast, we're going to talk about a hidden fee that I'd say 99% of traders don't know about until they start trading live. Unfortunately, it is something that you should take into account. Now, if you guys haven't done so already, make sure you support the Trading Coach Podcast by doing a few things. One, leave me a rating and or a review if you haven't done so already. Two, like, follow, subscribe, whatever you need to do wherever you're listening to this at. And three, share this with a friend or share your kind words with me. I've kind of gotten to the habit of taking the kind words that you guys have been saying about the podcast and how much it's been helping you and spreading the love out there. That way we can attract more people to the show and we can keep coming up with cool topics that, well, are meant to answer the questions that you guys have. And today's question started off from a former student of mine. He said, Akil, I was wondering if you can give me some advice on trading the pound yen pair. I have a strategy that has been back tested and I've been trading it live for over a year now. I trade it long and short, but due to interest rate changes, my rollover fees when going short are getting a bit higher than I would like them to be. I have been short for the past 2 days now, and I realized that the rollover fee from Wednesday to Thursday is usually tripled, and I have paid £38 so far in 2 days going short. And I may be in the trade for a few days more. I'll leave out some of the other specifics about his target 1 and target 2 were being hit and all this fun stuff. He said, this rollover fee has not been included into my backtesting results/data as I could not see a way of accurately predicting the fee. Now, my question is, do you have any info on a way to try to circumvent the fee? For example, closing the trade down before the start of a new trading day and reopening it, and any other tips or advice would be greatly appreciated. And I thought it was a good chance to kind of explain what rollover, or you also hear it kind of referred to as swap fees are. Because again, this is one of the hidden things that I don't think many traders know about, right? And you don't really need to know about it at first. Again, the first couple things we need to know about trading are kind of the learning the basics, how the market works. I guess this would fall under the topic of how the market works. But in general, before we should ever think about trading live and all the associated things that come with trading live, we need to focus on learning how to trade, and that's not thinking about the money. So I can see how this easily slips through the cracks. Even when we're going through the backtesting process, if you guys aren't familiar, the backtesting process is a process of acquiring historical data, testing our hypothesis, seeing what our edge is, and basically acquiring data to see if our trading strategy works the way we want it to work, and then what we need to do to tweak it and fix it and filter it to get it to work even better. And something that I've always said after backtesting is never assume that your backtesting results are going to be your actual live results. And I say that for two reasons, right? The most common reason is going to be human error, right? Backtesting is perfect. You get to look at historical data. You get to move the data at your will, meaning if you want to spend 20 minutes analyzing a 5-minute candlestick, you can. You can go back if you miss something, right? The job isn't to really simulate live trading. That comes later with demo trading. The job is to train your eyes to see what you want to see and acquire data. So you basically, if you're doing your backtesting correctly, you don't miss anything. You get into every trade at the exact point. You get out at the exact point, right? Everything is perfect. Unfortunately, live trading isn't so perfect. And in real life, there's going to be things like human errors. We're going to make mistakes. We're going to read or analyze the market the wrong way and be in a trade that we weren't supposed to be in. We are going to miss out on a trade that we were supposed to be in, whether it's, just missing it with our eyes, or maybe we slept in, or a meeting came up, or we forgot to set an alert, right? All these things are going to have an effect on our bottom line. Another thing that's going to have an effect on our bottom line, our P&L, is going to be fees, commissions, and spreads. And under those categories is going to be, or in that category is going to be your rollover. That is one of the fees that you're going to pay, the cost of doing trading. Now, the interesting thing about rollover, and I'll explain it in more detail in a couple seconds, is that it's not always a fee. Sometimes it can also work in your favor. So it's an interesting concept. And, I guess to take it back to the basics. So rollover, and sometimes you'll see it, if you're looking at your broker statement, you'll see it called as the swap as well. Basically, this is interest either paid or earned as the result of holding a position overnight, or rather over a session, right? So each day, and it's typically done off the New York session, right? When the New York session closes at 5 p.m., that is like the natural break between days. So imagine that like being like midnight, where it's 5 p.m. New York Eastern time. It's 10 p.m., I believe, if my math is correct, 5, right? GMT time. And that is kind of the break between one session to another. And the thing about Forex specifically, which is a little bit different than the stock market, if you guys are coming from there, is that we're not trading an individual asset. We are essentially trading the value of one asset versus another asset. So imagine, like, instead of just trading Apple or Microsoft, I am trading Apple versus Microsoft, or Amazon versus Tesla. And the whole, gain or loss is based off of how Tesla stock does in comparison to Amazon, instead of just the individual stock. So it's a little bit of a more complicated situation. And the thing about these currency pairs that we're trading, euro, dollar, euro, yen, pounds, whatever it may be, is that each of these individual currencies are associated with their own interest rate, right? If you've been in the Forex market or any financial market for a while, you know that interest rates are basically like the biggest gear that turns everything else, and all the small gears are based off of how it's going to affect the big gear. So it's a very important thing. So when you're trading these pairs, you're dealing with one currency and its specific interest rate versus another currency and its specific interest rate, right? So we're basically trading the differences in two different interest rates. So here's how it works, right? If the interest rate on the currency that you're buying, right? So let's say you're buying euro dollar, you're buying the euro versus the dollar. If the currency rate on the interest, or if the interest rate on the currency that you're buying is higher, bigger, larger, right, than the one that you are buying against, which would also be looked at as selling, but let's not even complicate that, then what's going to happen is that you are going to earn rollover or earn swap, meaning that you are going to be given money because of the differences in interest rate over that overnight session. And then vice versa, right? If the interest rate on the currency that you're buying is lower than its partner, then you are going to get charged a fee, right? And there's actually, it's called a carry trade. There's actually I don't want to call it trading because it's more like short-term investment, but there's actually an investment method that goes hand in hand with this as well, where if you see a massive disparity between two currencies and their interest rates, and you don't see any type of, closing of that gap, what you can actually do is you can just buy the currency with the larger interest rate against the currency with the smaller interest rate. You can hold it. Not only from a technical and fundamental perspective would you expect that the currency with the higher interest rate to be stronger than one with the lower interest rate, but you would also get a rollover fee each and every night that you hold it. So if you have a bigger, massive long-term outlook in a certain currency pair, meaning you're thinking like, hey, you don't see that gap closing for another, for months and quarters and years, a method to investing in the currency market is simply holding that position overnight, and you're kind of getting the best of both worlds, right? Not only are you getting the the perceived profit, because it's not profit until you take it out, the perceived profit of currency A getting stronger against currency B, but you're getting those swap costs as well paid into your bank account, kind of like dividends in the stock market. Now, full disclaimer, don't go out and just try to do that, because if you can get really cute and get in a lot of trouble really, really fast, especially when big news comes out and those things start reversing. The currency market is pretty volatile, but just want to give you a different look at it as well from an investment perspective. I did start off as an investor. I still invest to this day, even though we talk a lot about trading on here, right? So that explains rollover and swap, hopefully. And now going back to the trader's question, how can we deal with this? If we are in a situation where we're maybe more of a intermediate term trader where we're holding things overnight, our trades aren't playing out for days, weeks, maybe months, and we're getting killed on these fees, what are some solutions for that? And I have two solutions, and this is what I told the trader. One is what he mentioned, right? You can take the method. Well, let me start with a different one, right? One is you isolate the direction in which you trade, meaning that if you're getting killed with fees for going short, but you're getting rewarded with extra profit, dividends, for going long, then look into the situation where it's like, well, what would my trading results look like if I only traded long and I didn't trade short? Now, for many of you, you're going to look at that and that's going to be like a big mystery. But remember, we have that back testing data. We can easily go through that data. We can easily isolate all the long trades versus the short trades. And we can look at what type of effect that has on our bottom line, whether it makes a big difference, whether it is great for us, whether it destroys us, whether it makes no difference. You'll be able to see all of that within that data. And that's the cool thing about having that data. You can always go back to it and play around with it if situations like this pop up. Another solution would be to simply close out and re-enter the trade before the rollover, right? We say that a lot with weekend trading. A lot of people are afraid to hold trades over the weekend, which sometimes you see gaps. Gaps are very rare, and massive gaps are even rare, but every once in a while it happens, and there's this massive fear of that. And I think it's an irrational fear, in my opinion, but there's nothing wrong with wanting to feel safe. So what I'll tell traders is, hey, Friday night before or evening, whatever time it is, wherever you're at, before the session closes, close out that trade and then re-enter right away on the Sunday open. You can do that as well with this situation where, hey, if you don't want to pay that rollover cost, 445, let's close that position down. Let's open it back up, 515, something like that, and get back in it. Now, the issue with that is you are going to pay either commission or spread, depending on how your account is set up. If it's commission-based, right? Well, when you exit that trade, or let's say your round trip, when you enter that new trade, you got to pay brand new commission to be in that new trade. Or if you're paying spread, right? When you enter that new trade, you're going to get in at a little worse of a position. I guess depending on what your overall position is, you're going to get involved in a little worse position of where you were at before, and you have to weigh whether those costs are worth it versus the cost that you're trying to eliminate. Because sometimes we see this in back testing as well, or strategy development, sometimes the filter that you add to make your trading more profitable actually makes your trading worse. So again, you want to make sure you crunch the numbers and make sure you're actually helping yourself. But I thought it was a very interesting question. I thought it was a perfect excuse to cover a topic that I don't think we've done yet here on the Trading Coach podcast. So I hope you guys enjoyed it. As always, like I said before, leave me a rating review. Make sure you follow me on social media at Akil Stokes RTM. I've been doing all sorts of cool little short videos where I get a lot of questions, and not all of them can be branched out into Trading Coach podcast episodes. Some of them only take about a minute or so to answer. So what I do with those is I create a reel, a short, a TikTok, whatever you want to call it, and I put it out on social media. That way you guys can have it in your library. So make sure you follow me at Akil Stokes RTM. And until next time, plan your trade your plan. Take care. Hey guys, if you want to learn more about backtesting, strategy development, or learning how to trade in general, make sure you check out our educational platform, www.tier1trading.com. We have trading lessons, we have live supportive resources, and we have a great community of traders of all levels that are willing to help you and really guide you through the journey, along with some awesome coaches like yours truly. So check us out, www.tier1trading.com. I recommend starting with the 14-day risk-free trial membership. Gives you exposure to the platform. You can see if we're the right fit. And there's no like shady auto bill or anything like that. You're just kicked out after 14 days. www.tier1trading.com, and I'll see you guys there.